Great. So I think we'll kick off. Eytan, can you hear me?
Yes, I can.
Perfect. Good morning, everyone. Thank you for joining us. For those who stayed up all night to watch the election results, hopefully you'll have a chance to go to bed shortly. For the rest of us, hopefully we got sleep last night. So as many of you know, one of our focuses at Pioneer Wealth is on ongoing service to our clients, keeping you informed and updated on what's going on in markets and investments, but also broader issues that are relevant and of interest to you. I know a number of you on this webinar joined the last one that I hosted, which was with Katie Martin, the Global Markets Editor of the Financial Times newspaper in London. And this is another in this series where we focus on issues beyond just markets and investments, although we'll touch on that later, and look at perhaps some of the really crucial issues that affect investors today. And for that today, we are honoured to be joined by Eytan, who is the founder of The Marker and the editor-in-chief of The Marker magazine, to look briefly at last night's election results, or this morning's election results, but to focus in much greater detail on what's going on with the Israeli economy, with interest rates, and perhaps most importantly of all for us as investors and Pioneer clients, the Shekel. So without further ado, thank you for joining us, Eytan. Let's kick off with a look at last night. Went to bed thinking the results were going one way, and on my way to the office this morning, it seemed that they might be veering in a different direction.
Yes, well, thank you, Andrew. Thank you, everybody. I hope you can see me. Indeed, I am the one of the founders, not the founder. There are several ones. One of the founder of The Marker. I've spent 15 years with Reuters before that, setting up the Israeli operation, both on the side of trading in shekel dollars and also on the editorial side. So I've been following the Israeli economy for over 33 years now. And well, you guys could not choose a more interesting morning for this conversation, although it's going to be very difficult to say anything that is very deterministic and to announce what the following years are going to be in the Israeli economy or in Israeli in general, because as you may know, the results are very, very inconclusive. And not only that, they're not final. In spite of the fact that by now, almost 90% of the votes have been counted. There's still 10% left. And more important than that, there are about 500,000 to 600,000, what we call in Israel, double envelopes, which means that they need to be counted and the result may not be in the final result before Friday morning. So what we see now is some kind of a draw between the party that is for Bibi with Benjamin Netanyahu and all the rest which are against them. And interestingly enough, whereas in many countries, usually, you know, people say it's the economy stupid and people vote on economic line as to whether it's going to be more social democratic, liberal style or more conservative. In Israel, the election were not at all about these topics. They were about whether you like Benjamin Netanyahu or you don't, and whether you agree with certain issues that are very important to Israelis, such as what could be the final solution with regarding the occupied territory and how should the relations with our neighbors and the Palestinians be, and all of these topics. Religion, many parties were against religion, the other ones were upset that they were being attacked. And we did not have a discussion about the coronavirus. We did not have a serious discussion about economics and the influence of the crisis, the coronavirus crisis on the economy. And people voted along party lines and along lines of what we say in Israel, what tribe do you take party in? So if you're religious of this kind or religious of the other kind, whether you're Ashkenazi or maybe you're Mizrahi, so you voted for that. And it goes the same for the center left. People have allegiance to parties. The Labor has had a good showing with 7 members of parliament. The left-wing party Meretz, who was in danger of not passing at all the minimum 4 votes needed, got in with 5 or 6 votes. It's not final yet.
Okay.
In the middle of the night, I could have tried to give you some kind of economics perspective as what might be the next government, in the sense that it's still going to stay with Benjamin Netanyahu and the Likud party as the main party in the government, and Benjamin Netanyahu as prime minister, and that could very well still be. But mostly that one party, the Yamina party, headed by Naftali Bennett, which I understand some of you are from Ra'anana, so he's from Ra'anana as well. You might have seen him walking around town. But should he be the important party, the one that clinches the coalition for either side, then he might be in a position to choose what minister he wants to be, or what ministry to be in charge of. And they have hinted him, Naftali Bennett, as well as his partner Shekel, that they are very interesting in the Ministry of Finance, which is the one that set up the economic policy and the economic condition. And should that happen, if Bennett becomes Minister of Finance in charge of the economy in some way, then if that happens, and it could still happen, it just looks a little bit less likely this morning because of 1 or 2 members of parliament that have moved from the Bibi bloc to the non-Bibi bloc, but I still think there's a fair chance that this scenario might happen. Then, for the first time in Israel, you will get in the Ministry of Finance, maybe in charge of finance, maybe in terms of even Netanyahu letting him do whatever he likes, because Benjamin Netanyahu does not like to deal with the economy. The economy is a complicated matter. It's difficult to provide the election promise that you've made before the election. It's a number and fact based topic to deal with, ministry to deal with. It's much easier to be the guy who's in charge of defense and geopolitical relation, because you travel the world, you talk with other leaders of state, maybe you manage whatever confrontation there are. It's easy to do because you never get to actually give, or you never get to actually provide what you have promised. So if you promise growth and you don't do it, it's a problem, because you see it after a while, after 6 months, after a year, after years. If you promise lower prices for real estate, then if after a year or 2 they still go up, then you failed your promises. So in the past, in fact, since 2011, after there were some serious social demonstrations in Israel, some of 2011, 10 years ago, Bibi has basically made a decision between himself and his family to deal as less as possible with the economic. And he's giving it to other parties. So in the first 4 years, he gave it to Yair Lapid. And Yair Lapid did not do very well and lost a lot of power. And then for the next 4 years, he gave it to another guy, Moshe Kahlon, which is not in the picture right now. But again, Moshe Kahlon tried to do several things. He tried to lower prices of housing for younger Israelis. He could not do that. They have actually doubled since in the last 10 years. And Bibi was exempt from being, in charge of all that and proving that he can actually do it. So if Bennett comes and says, I want this ministry, there's a good chance, if they actually can do it in general political terms, then he will get it. And again, for the first time in Israel, you will have a guy which is the declared, maybe not by name, but by policy, conservative Republican. He has actually presented the last few weeks an economic plan, which he refers to as the Singapore plan, because he has taken some idea from Singapore. But when you look at the basic idea, what you see is something like Reaganomics. It's a little bit like what Reagan proposed and actually did in the well, you know, the 80s of the previous century. And so the basic idea of Bennett is that he's going to lower taxes for everybody. He's going to cut and diminish a lot of market regulations on all kind of different sectors. Presumably, if you cut significantly taxes and you have less tax revenue, then you can provide less social services. And it actually looks like a little bit what Donald Trump has tried to do when he came in the White House 4 years ago. Again, Reaganomic style economics. Since then, many economists have analyzed what happened in the United States in the middle of the 80s, and most of them agree that it was not good for the economy in general, and it has hurt a lot of people who are not part of the 1% or 5% or 10% richest people in the economy, which you may know about. But that's a discussion that is open in every economy in the United States, definitely in the United Kingdom, not so much in Israel, but that's what might happen if Bennett gets in the coalition with the power that he has, because he can sort of choose who is going to be the prime minister by the fact that he's the one, although he has only, what, just now, this is from an hour ago, he has only 7 members of parliament out of 120. He can still influence very much, possibly even choose, possibly even set up a deal in a rotation with somebody else that he will be prime minister for a while, and maybe either Benjamin Netanyahu or Yair Lapid from the other side, largest party, Yesh Atid, who has 17 members of parliament right now. They can somehow cooperate and rotate between themselves over the next 4 years. And
okay,
Eytan,
sorry, I was going to say, if we could just move on, because we had a number of issues I wanted to cover and obviously limited time. And then in the coming days, we're going to hear a lot more about what's going to happen.
You be the clock master. You be the clock master. Yeah. So just to summarize this yeah.
I was going to say, I mean, as we discussed previously, one of the biggest issues for Pioneer clients, many of whom have made Aliyah from places outside of Israel, is the shekel, with income or assets perhaps still denominated in dollars or pounds or Iran. You know, what happens to the shekel is really critically important.
Okay.
But why has the shekel been so strong? And it really has been one of the world's strongest currencies in recent years. And is it a trend that you think is going to continue irrespective of who runs the next government?
The short answer is yes. I expect the shekel to continue to be strong, not necessarily to continue to strengthen dramatically the way it did in the last 12 months. It actually strengthened by, depends what date you take, but between 6 and 8% over a year against the dollar and most other currencies. So the bottom line is I expect it to be strong, and I'm going to try to explain why is that. So if you look at the slides, in fact, in a currency, there are many reasons that influences the currency rate between any two currencies. But at the end of the day, it's about the amount of foreign currency that enters the country against the amount of foreign currency that actually leaves the country. And when you go and you check the flows of mostly dollars, but any other currency that come into Israel every day, every week, every month, and easier to count every year, then you see that there is a very, very large inflow of dollars coming in. And this is what, at the end of the day, always sets up the rate. So if you can put, I'm going to just summarize some of the major flow, the major flows that come into Israel. You can see here the foreign direct investment in Israel in 2020 was at an all-time high of $25 billion. Foreign direct investment is basically, a lot of it is in high tech. So put on the side $25 billion that come in, mostly for startups, high techs, but not only that, any other of other investment in it can be gas and it can be infrastructure, etc. So that's $25 billion coming in every year. And then you have the current account, which is all the other flows, meaning it can be the difference between export and import. It can be foreign investor Jews mostly who buy apartments. Quite a lot of that were from the UK in the past few years. I'm being told that this year mostly Americans are buying apartments. It can be donation, it can be just about anything. But again, you're talking about another chunk of 20, actually $21 billion coming in to Israel in 2020. So if you just by adding those two, you get 40, maybe 45, almost $50 billion more currency coming into Israel than currency going out of Israel. Now, interestingly, a big chunk of that was a jump. If you can see, this is in Hebrew. The green line here is the rise in export of services. And we also had something that was specific for this year, for the coronavirus. One of the parts of the current account is obviously how much export we sell abroad in Israel and how much import we bring from abroad. And the exports were not hurt by the corona because lots of it is high tech, which had a very good year, whereas import were hurt because people bought less stuff from China and from other countries, and also because they did not go on vacation abroad. Many Israelis every year take several trips a year to Europe and to many other countries, and when somebody leaves the country and takes $2,000, $3,000, $4,000 with him and spends it away, this is an import of services. So when that was canceled, lots of dollars stayed in Israel, whereas usually in a normal year they would leave out and sort of cancel some of the money coming in. This did not happen. However, this is expected to renew and to begin again once the economy and the airport again opens up completely and other people begin to accept Israeli tourists. And I'm again, just a few days ago, Greece and Cyprus and some other countries have announced that people who have been vaccinated in Israel can, as of next month or maybe even next week, travel to and take vacation in those countries, which means that maybe the surplus in the current account, maybe it will not be in 2021 as big as it was in 2020. So if you count the direct investment and then you count the current account, which is the export of services and high tech, and then you had this graph here, which is a little bit complicated, but I'll make it simple. The fact is that Israeli institutional investors, meaning the people that manage the pension funds and basically portfolios and basically every financial asset in Israel, have because Israel is small and the economy in general, and because they get a lot of money from the Israelis that are saving, then they have invested a lot, meaning almost a third, definitely more than a quarter, but almost a third of the assets of Israeli pension holders abroad. And they have to, at the end of the day, to everybody who is investing for a pension, to provide a stream of revenues in shekels after somebody has gone into retirement, and they need to hedge that foreign investment, mostly in the United States, in the United States stock market and bond market, etc. They need to hedge that to shekels so they can provide pension in shekels when somebody retires. So they need to buy and sell shekels against the dollar every time that there's a move in the market, so every time that there's a move in the currency. And what you see in green is each time that they are actually buying dollars each month. The red ones for each month is when they are selling dollars. And because there's more money going in out, and because the stock market has gone in, so just by the fact that the numbers have grown, and the part of the foreign investment in the Israeli portfolio has been growing, they needed to hedge more and buy more dollars. So this can also goes both ways. If the American stock market and stock markets around the world will go up in 2021 like they did in 2020, even or even if a bit less, then they are going to need to buy more to sell more shekels again, and again this will hurt this will strengthen the Israeli shekel and hurt the Israeli dollars in local terms. So at the end of the day, if you take all of these flow, the FDI, the current account, which is the difference between money coming in and money coming out for export and import and other flows, and you add the actions of institutional investors in Israel who need to hedge their currency exposure, then you get what we saw last year in 2020. And there's no big reason why this should not be the direction and the trend also in 2021 and 2020 and 2022.
Okay, so what you're really telling people who are watching is if they are hoping to see a return of 4 shekels to the dollar or 8 shekels to the pound, they're probably not going to see it anytime soon.
No, actually, nobody expects that whatsoever. The only reason, if you can show maybe in the next graph, the only reason, well, and two more. Okay, continue that. One more. Okay, leave it at this picture of this guy. Okay, the only reason, this is of course the chairman of the Israeli Central Bank, Professor Amir Yaron, and the only reason that the shekel has stopped strengthening 3 months ago when it reached a rate of 3.11 shekel to $1 is because this guy and the people at the central bank have decided that this is enough, that the Israeli economy and mostly the high-tech sector cannot afford at this time of economic crisis to strengthen an even more strong shekels, and they have put in place a dramatic policy for the currency market by announcing that they will purchase whatever happens and in any condition $30 billion of in the Israeli market. And this number 30 billion comes from exactly what I've described to you a few minutes ago. They have counted the amount of dollars coming in, and they said we're going to buy almost all the dollars coming into Israel. So they reached a number of 30 billion, and they actually added that it's not final. It can actually be more than that, but at least $30 billion will be purchased by the central bank in the Israeli currency market in 2021 for the whole year. And indeed, just this announcement has stopped the strengthening of the shekel, and it actually went down from 311 to this morning. I think it's no big change from yesterday, in spite of the election results, or because the election results are so inconclusive. It's more or less flat this morning at 3.30 or 3.29 shekels to $1. But the whole game is, I've showed you the number. By the number of and the economics themselves, the shekel should strengthen again. However, right now Amir Yaron is buying 2/3 or 3/4 of all the shekels coming into Israel. And he's been doing that in January and in February and in March in dramatic number. He's already used up almost 1/3 of this bank of promises, if you want to call it like that. More than $10 billion is already bought just from the beginning of the year, and should it choose to, it could buy even more, and it could stop any strengthening of the shekels or not. So what you have is that most economics and most trading rooms in the foreign banks that trade in the shekel, dollar, and other currencies say that okay, you know, there's still more money coming in, more foreign currency coming into Israel than this number. There's 40, maybe more. So nobody expects the shekel to go down dramatically, and people do expect it possibly to go up again, maybe when everything quiets down and world economy goes back to normal. But your best bet, in fact, is that it stays in a tight range around what we see today, maybe 3.2 to 3.4, and not dramatically out of it, with the Bank of Israel, in fact, setting up the rates quite aggressively. This has not been done by a lot of countries in the world at all. Switzerland has fixed the rate against the euro for a long time. Czechoslovakia did the same for a long time because of similar problem of their own country strengthening too much and hurting their economy. This is what happens now in Israel. So to summarize, the economic forces are again and for the foreseeable future for more strengthening of the shekels. However, the Bank Israel is stopping it now at the current rate and seems to be happy with this current condition.
Okay, that's really interesting. Thank you, Eytan. I mean, last year, as we all know, was one of unprecedented challenge in the world with the COVID pandemic. And around the world, central banks launched unprecedented amounts of intervention to try and stave off economic collapse, led, of course, to interest rates coming down to almost zero in most leading economies and markets. You know, we're, please God, coming out of coronavirus now here in Israel, and countries like the UK and the US show signs of following suit, even if the Europeans can't get their act together on a vaccination campaign. So where does that leave interest rates and debt issues as the world moves past the COVID pandemic?
Okay, I had a slide actually from the United States. If you can show it, it's the Federal Reserve balance sheet. Could you go up?
I think it's an earlier slide, no? Yeah, it's an earlier slide.
No, go up.
Back a bit. Yeah.
Back a bit. You'll get it in a minute. Okay, this one. Right. All right. So right, this is not Israel, but actually, and I'm giving quite a lot of talks and lectures in the past few months about this this one graph. If you want to understand what happened in the world in the financial markets all over the world, definitely in the United States, but in every other country, then this is the one graph you have to remember, because this is the asset of the American Central Bank, the Federal Reserve. You can see what happened in the financial crisis in 2009, which was a bigger disruption in economic terms than this crisis. The unemployment went up in the United States more than it did now, and people actually fear that the whole financial system is going to crash, and it lasted for quite a lot of years, maybe never ended. But if you see what they did, they bought, or they grew from assets from $1 trillion of assets to maybe 2.5 trillion of assets. So they doubled that, or added 1 billion, 1 trillion, 1.5 trillion of assets, and this is by buying government bonds from the American markets. And now, if you just jump to on the same graph, and if you look at the 2020, what you see is they jumped from 3 to 7. So in fact, what the Fed did is 4 times as big intervention of printing money, by printing money and buying government bonds and corporate bonds and all kind of assets, but trying to lower long-time interest rates and trying to set up a situation where it's no good for anybody to hold money, to store money, to put money in safe safe bonds, even though the rates are not so attractive, and just force people to actually either spend the money or invest in long-term project, or do anything, put it in the stock market for that matter, do anything. And this is the one graph that actually explains what happened in the world, and everybody is doing the same. Now, the interesting thing is, and this graph is the right one, is that Israel does a very similar thing. It does exactly the same. In March 20, and now it's been almost a year, every month, you can see the numbers here, the Bank of Israel is doing QE, the same thing as the Federal Reserve, by buying 4 or 5 or 6 billion shekels of government bonds from the market, thereby keeping the prices of government bond very high. That means that the yields are very low. They're negative in the very short for very short bonds, and they're marginally positive for very long bonds. And so you still have right now at this situation all the banks in the world, all the central banks in the world, definitely the Fed, but also the Israeli one, doing everything to keep interest rates very low, both on the short term, what we call the interest rate. In Israel, it's 0.01%, and on the long term. However, markets now expect the economies, the global economy, the US economy maybe more than others, and the Israeli economy to start getting out of the crisis, and the economic condition to get better, and the growth to reignite in 2021 and 2022. So what you have here in this graph, on the red part, the red one is the expectation of the market as to where interest rate will be, short interest rate, the one we usually refer to, in the future, in what can I say, the next 4 years. And you can see that it's not going to change in 2021, but by the end of 2022, rates in Israel are expected to rise from 0.01 today to almost 0.5%, 0.04%. And then a year after that, 2023, 0.8%, meaning almost 1% at 2024. And you can see the same expectation of the market for the dollar rates, which are lower than that. Again, they expect to rise, but slowly, maybe 0.25% next year, 0.75% 2 years from now, maybe 2% in 2025. By the way, this gap between the red line and the blue line means that the shekel is going to be more attractive, because if by next year, 2022, we give 0.4% to anybody putting money in a bank in Israel, and the American give only 0.25%, this seems small, but it's a good enough reason for a sophisticated investor who knows how to leverage any small difference to put to play the market. That means they will again buy shekels. So if anything, if you can take anything from these graphs, which are the expectation of the markets, is that it's another reason for the shekel to strengthen next year. So the Bank of Israel is going to have a difficult time holding the shekel where it is for this reason as well. And you can see that the rates are going to stay low compared to what we were used to before the financial crisis a decade ago. But still, they seem to be going up all over the place.
Okay, thank you. Just to move away with my final question, away from currencies and interest rates, more to the broader Israeli economy specifically. As with most countries, enormous economic damage has been caused by COVID for many people, their lives, their businesses, their finances. How is Israel, which doesn't necessarily have the firepower of, say, the US government, going to pull itself up, and what kind of shape of economic recovery do you see coming to the Israeli economy?
Okay, so surprisingly, what you see in this graph is the unemployment picture, which is probably the one you should remember, because surprisingly, the economic conditions or the loss of economic activity in the COVID year, March to March, March 2020 to March 21, has been lower, actually much lower than what people feared during the lockdown. Really, the game changer of the vaccinations, the fact that Israel basically is about to be fully vaccinated quite soon in a couple of months, not more than that. And actually, the fact that other parts of the globe are picking up economic activity again. The Americans are vaccinating quite fast these days. Over 130 million people have been vaccinated, at least in the first shot by now. So they're doing it fast. Europe is lagging behind, but the Chinese don't need to be vaccinated so fast because they don't have a lot of corona sickness over there, and all of that area in the world. So in fact, the economic condition is not as bad as people thought only a few months ago. So the expectation for a sharp drop in economic activity has been proven wrong. The drop was only 2.4% in GDP in 2020, and it's picking up again. In the United States, you can see in that graph, unemployment has spiked in the first lockdown, but it's gone down again very fastly. It's only 6.3% now in the United States, and actually many people are thinking that this is going to be a very good year, 2021, in terms of growth in the United States, in many countries, as well as in Israel, in fact, because you have the coronavirus and the corona sickness basically withering away. And on the other side, people have learned to operate all the digital equipment. They've learned to do a lot of things by internet. Stuff is being delivered at homes, and there's been a big jump of productivity in just about every sector you can think of. So that's a plus from this whole sad affair. But it seems that economic growth is picking up fast, and maybe the world and the United States and Israel are not in such a bad condition as people thought, and maybe numbers will surprise for the better in the next few months and during 2021. So if you take the whole picture, in general, the Israeli economy is doing okay, and is going to do quite well in 2021. The problem here is how the distribution of this next good year, 2021, is going to be among Israeli citizens. And what you see here, that we in Israel, contrary to Asia and the United States, have a serious problem of unemployment, because lots of people in lots of sectors that employ mostly in part-time jobs. So you have restaurants, you have hotels, which are still, they've been reopened, but there are no tourists right now. So people work in hotel, people work in entertainment, people work in restoration, anything that had to do with everything that has closed during the lockdown. These people went into unemployment. Lots of them are still getting unemployment benefit, which is almost 80% of their salary. And even if they are being offered to return to the restaurant they were working at, or the hotel they were working at, they say, no, I'm not interested. This is a part-time job anyway. I'm getting paid for the government until the month of June. So that's another 3 months from now. Why should I go back to work? And so you see a lot of numbers. A lot of people are staying at home. Some people have changed profession. Maybe if they're young, they've gone back to university and college. Some have begun to do all kinds of things at home and cooking stuff and selling it around. Maybe they won't even go back to the places they worked before, being people who are working either part-time or temporarily. And the unemployment picture is supposed to get much better as this special unemployment benefit program ends in June. However, many people are still not going to find work because lots of restaurants have been closed. We don't know how fast tourism is going to pick up again, tourism of people coming from abroad. And so what you get is a very good economy for people who have work, a very good economy for people who are employed in the high-tech sector where salaries and demand is going up all the time. It's gone up in 2020 during the lockdown and the recession, and it's definitely going to go up again as things open back. So it's a distribution problem. It's really a problem of what to do, of how to share the value added of this strengthening economy. If you had a good business, whether it's finance, whether it's startups, whether it's retail, if you can provide your goods by the internet and by and you know selling it, bringing it to the people at home. You know, the description of a bad economy right now is not a good one. It is definitely a troubling and an important question as to how all this is going to be distributed in the country. What's going to happen with many young people who have no jobs in the job that were actually lost in the economy. But as a whole, the economy is going to do better, probably better than many other countries, definitely in Europe and the UK.
Okay, great. That's really interesting, Eytan. I think from all of the people listening in today, whether you go to the Jerusalem Post, Haaretz English, the Times of Israel, the problem is the complete absence of quality comment and information about the Israeli economy and issues like the shekel and interest rates. For those of us who aren't fluent enough to read an Israeli newspaper or publication like the Marker, you're sometimes wondering what really is going on in the Israeli economy. And I think this morning has really provided a great opportunity for us, Eytan, to have a broader and deeper understanding of really what are key issues for everybody on this webinar. You know, the outlook for interest rates here, the outlook for the shekel, the outlook for the economy, and that's been really excellent. So thank you for that. Okay. We've had some questions, but they've tended to just ask on the topics that we've already covered. So given time, I think it's probably appropriate now to thank Eytan again and to move to Mike Ellis, who's our Chief Investment Officer here at Pioneer Wealth, to just give us a brief update on what's happened in markets and investment arenas in the first quarter of 2021. After a very bumpy year last year, Mike, at least it's not been quite so roller coaster-ish.
Yeah. Well, firstly, thank you, Eytan. Thank you, Andrew. I just want to give my perspective on some of the points that Eytan raised and what does it mean from a portfolio positioning point of view. While I just share my presentation, I'll just say that I fully agree with Eytan's view that the outlook for the shekel, the probability of a stronger shekel is higher than the probability of a weaker shekel, and we'll probably stay range bound for the short term. But if we take a 3 to 5 year view, there's a lot of data points pointing towards a stronger shekel. And as Andy said, it's tremendously significant for our clients from a financial planning point of view. Okay, so I've entitled this presentation, "Is This Time Different?" And that's mainly because this is a question that I'm asked in client meetings. Socially, people approach me and they say that the stock market's at an all-time high, the world's so scary, economies are weak, too much government intervention, etc. And investors are concerned and they're considering taking money off the table, or they're considering delaying going into the market, etc. So this phrase, "is it different?" was originated, I think John Templeton in the 1950s wrote an article and said that this phrase is one of the foremost dangerous words in finance because it implies that we're able to time the market and we can read the signals and do, adjust our portfolios. And The client perspective is, yeah, well, the advisor, the banker, whoever, he's trying to convince me to remain invested. And the advisor perspective is genuinely long-term. So, and this question of, is the market high, comes up every time that, this question of, is this time different? It comes up every time the market feels high. So we're breaking records. The S&P is at an all-time high. And maybe people are feeling that they want to take some profit off the table. I got calls from avowed investors who would say that you cannot time the market. And they're saying, well, maybe we should take some profit off the table. So I feel that this phrase, this time it's different, is dangerous because it implies that we're able to time the market. And we feel that we're unable to time the market. But I will actually agree with the phase. And I think Eytan expressed this, especially with his slide about the extent of the US balance sheet. This time is different, okay? And I'll show you why that is. I'm sorry if I'm rushing because we try to keep this presentation certainly under 50 minutes, but I'm gonna, if anyone wants to hear this in a bit more detail, on Monday the 5th at 5 p.m. we're gonna do our quarterly webinar, and you can get the details and listen at a bit more leisurely pace. So here's the stock market. You can see from January last year through to last week. Obviously, the tech stocks, the high multiple stocks, the high growth stocks did fantastically up until the launch of the vaccine, or Biden coming to power, whatever you want to call it. And you can see that the S&P has done not bad, but it's in positive territory since the beginning of last year. Emerging markets, funny enough, catching up very much with the S&P. And Israel and Europe are lagging behind at the bottom here. So that supports our view that we're very pessimistic on Europe, but we run Shekel portfolio, so we have to remain invested in the Tel Aviv Stock Exchange. And interestingly, year to date, the Tel Aviv Stock Exchange is definitely doing a lot better. Within the equity market, one should be always cautious not to paint the whole equity market with one brush. This slide shows that within the equity market, very different things are happening. So when we say equities, one should be careful not to throw out everything. So, for example, leading up to the announcement of the vaccine, high growth stocks, NASDAQ especially, did exceptionally well. But since the vaccine, or since Biden came to power, it's a negative territory, and value stocks are coming up. The main value stocks are financials. That's a sector that is giving us confidence going forward, because it's the essence of the economy. If banks are strong, banks are doing well, banks are in favor, that's one of the signals that we should look at. Why is this time different? As I said, I do feel that it's different. Eytan touched on it on his slides. We've got incredible government intervention in the market. I would go so far as to say the markets are artificial. The economy is not artificial, but markets have this element of government intervention, whether it's monetary policy, low rates. Eytan's slide about the interest rates, I think the big picture there is that even if you stretch it out to 2024, 2025, 1.75 on the 10-year in 2025, that's still low interest rates. Those are low numbers. And low interest rates mean higher valuations. It means it's going to be more supportive of higher equity multiples and supportive of growth. So monetary policy from an interest rate point of view is supportive. Then the government comes in and buys bonds, both in Israel, as Eytan said, and abroad. Every time the market has a fright and a bit of a wobble, and there's a bit of a risk-off environment, the government steps in, provides confidence to the bond market, that filters through to the rest of the market. And the central bankers are invertibly acting as volatility dampeners. Then there's unprecedented fiscal expansion. The US, which is the focus of the dollar portfolio, obviously, we haven't seen this type of fiscal spending since World War II. And the combination of this monetary policy, aggressive monetary policy and aggressive fiscal policy, there's no reference or playbook. We haven't seen it and before. And I think overall, this gives us a lot of confidence for risk assets. And I can't emphasize this enough, there's a tremendous amount of cash sitting on the sidelines waiting for opportunity. So if the market goes down, I believe that some of that cash will come in. A presentation I heard the other day, BlackRock estimate that there's $16 trillion worth of assets, or $18 trillion worth of assets on negative returns. So you can just imagine being an asset manager or an investor or pension fund having negative returns. It doesn't take much to sell that negative yielding asset and buy some risk asset. So that's going to give a lot of support for risky assets. Okay. Inflation. I just want to give a few words about inflation. Inflation is probably the big medium to long-term risk. It's not a risk for 2021, in my opinion, but it is a risk. We don't fear hyperinflation like Zimbabwe and post-World War I, but we do think that there will be high levels of inflation. And the Fed has set this healthy number of 2%. So if for the last 10 years, we've been running below 2%, we think we're going to go comfortably above 2% for a while, and the Fed are going to let inflation run a little bit. One thing that I think that people don't fully realize is that modern Federal Reserve governments, whether Israel or the United States, we've learned how to control inflation. So what happened in Israel in the early 1980s or other countries around the world, I believe that we know how to control inflation. If we need to, there's a lever they pull, they raise interest rates, and they will control inflation. It will be painful, but they can control inflation, and we won't have to go for hyperinflation. So if we have these high levels of inflation, I believe it is supportive of risk assets, especially equities. So I'm not talking about way higher inflation, but let's just say any number between 2 and 3 will probably be supportive of interest rates. And one shouldn't fear too much these increase in interest rates we've seen in 2021. These are optimistic signs. Yes, it's been a little bit painful for bond investors, not a crisis, but these are signs of optimism, not pessimism. So one should not fear that too much. Okay, I apologize if I'm rushing a bit because we did want to keep this under time. Overall, optimistic about the macro environment, even if it is strongly influenced by government policy. We expect there are risks, obviously. There's vaccine rollout risk. Eytan summarized that. We're very cautious about COVID losers. For example, airlines, we're not buying those. I think there's still a lot of pain to come because we have many more months before we normalize in service industries. And inflation is a problem for medium term, not 2021. So our message to clients is you should be at your maximum equity allocation that you can tolerate from a risk point of view. And within that equity, we like the United States still, even though it's very high multiples, and we like China. We're less enamored by Europe. Okay. Another subject I get asked a lot about is how to protect your portfolio from inflation. We're not big believers in gold. I think the link between inflation and gold is broken. That's leftover mentality from the 1970s. If you're going to hold gold to protect you from inflation, you need to hold a lot. You need to hold 30% of your portfolio in gold. And most investors can't handle the unpredictability and volatility that comes from that. This year, the story has been inflation and rising rates. What's gold done? It's gone down. That kind of proves the point. Also taking a longer term view, post 2008 crisis, gold halved in value. And you cannot have an asset in your portfolio which is designed to protect you that can lose half its value. Same applies for Bitcoin. Long story, I don't want to go into it too much. So we're not fans of gold. We're not fans of Bitcoin. I do think that equity exposure will, to an extent, protect you from inflation, and obviously property, as long as it's the right type of property, could also be useful. So that's the problem. Where's the problem? As Eytan said, is quality bonds. Yields are too low. Just looking at this graphic, I'm sorry again if I'm rushing, but this graphic shows where bond yields are today. The dark blue line, if you look, I don't know if you can see my mouse, investment grade bonds, 1 to 5 year. This is the meat of a traditional private client portfolio. Historically, you've got a lot of money in investment grade bonds, and the yields there are currently 1%. And that's before fees and before expenses, etc. So this is the big challenge for investors, because this was definitely the meat. And you can see that going back to September 2007, the light blue, we were at 5.4%, and then 2012 we're at 1.6, but they came back up a bit, and now very, very challenging environment for a conservative investor. Why do we like bonds? Because they're predictable, far more predictable than equities, but these returns are not interesting for investors, so we have to challenge the thinking, maximize equities, and look for alternative investments that can weather whatever inflation comes ahead. Okay, I'm going to open up for questions. I think, Andy, we've got, again, I apologize if I flew through it a little bit fast. Anyone who wants to hear that in a bit more detail, next Monday, the 5th of April at 5 p.m., you can get the link from Andy. I see one question. If so much cash is sitting around looking for opportunities, the quantitative easing seems a contradiction at a macro level. I assume that free cash distribution is mostly with strong investors and not the average population. Correct. Y equal to... I'm not
trying to take the question offline, Mike, afterwards.
Yeah, I'm going to try to answer this offline. It's a little bit complex question. I'm not sure I fully understand it.
Okay.
But the cash that I see in high net worth, ultra high net worth investors and pension funds, the ultra high net worth investors are sitting on too much cash because throughout Corona, they wanted comfort cash. It wasn't an asset class. It was pure behavioral finance. They wanted to sleep well at night knowing they had this money. It wasn't about the interest that they weren't earning on that money. It was about the scary, the way, the state of the world, so to speak. Institutional cash, this is coming from bonds that they would either sell or be forced to sell, or they're in negative interest rates or things like that. So that's where the cash is coming from. If that answers the question, I'm not sure, but I hope it does.
Great. All right. Thank you, Mike. I think we'll wrap up there. We are heading to 12 o'clock in Israel, 10 o'clock in the UK, for those joining us from London. I wanted to thank Eytan Avriel very much for a really incisive analysis of some of the key broader economic and fiscal issues that we're facing. To Mike for Market Update, which will be carried out in greater depth and at a slower pace on the 5th of April in the afternoon. We'll be sending out promotional material about that. And to wish everyone who's joined us a Chag Pesach Sameach v'Kasher and a healthy year ahead. Thank you very much for joining us.
Thank you.